I always think it's important to go beyond recording transactions to really understand how to use financial accounting information to make decisions about the health of a company, about the performance of an organization. So let's look at just a couple of metrics we could use when analyzing long-term assets for a company. Now, there are a number of metrics that we could consult, but arguably one of the most common is the fixed asset turnover ratio. If you look at this formula, what we're really measuring here is, like a lot of ratios that we deal with, we're measuring something that gets reported on the income statement. In other words, in this case, sales revenue. And then we're measuring something on the balance sheet. Now, I'm not suggesting that every ratio involves an income statement account and a balance sheet account, but plenty of them do. And this is a fine example. So what we're doing here is we're looking at, in the denominator right here, what is our investment in fixed assets, okay? In some sense, you could think about it this way. What resources have we committed to building our infrastructure? And then in the numerator, we're looking at what did we do with that investment in infrastructure, okay? Higher is better here. What level of sales revenue are we generating with what we have invested as far as infrastructure and fixed assets? So let's look at an example involving a real company. The math associated with this particular ratio is not all that difficult. You just have to know where to find the information. Take a look at the balance sheet here for Blake's Coffee House. We have comparative balance sheets at the end of 2018 and 2017. And let's focus on the denominator for the formula here. We need average net fixed assets. We're going to grab that information right here. Average is simply beginning plus ending divided by 2. So you can see that at the end of 2017, our fixed assets were $284,000. Let's just plug that in over here. And then a year later, at the end of 2018, we reported net fixed assets of $285,000. Now, you can just eyeball this and you can see that the average is going to be $284,500, just simply because that's halfway in between those two values. Oh, and I may or may not have made the math easy for us by doing that. So now we have the average net fixed assets, and we can plug that in right here, $284,500. Last part of this formula is revenue. Now, when we do the revenue, it's going to be revenue for the current year. So down here we have a summarized income statement, a portion of an income statement for this coffee house. And we can see that the total revenue for 2018 is $627,000. So plug that in. And we come out with a fixed asset turnover ratio of 2.2. Okay? As I promised, the math is not incredibly difficult. You just have to know where to find the information. Now, thinking about this average net fixed assets, some companies may use gross fixed assets in the denominator. In other words, they may choose to grab these two numbers, which in this case would average out to $295,000. I believe it's more common for companies to use average net fixed assets. If you choose to use gross fixed assets, just know that you're doing that and then use it consistently within your company from year to year. And if you're comparing to other entities, you would want to know what they're using in the denominator. The key is to use something and use it consistently. Now let's talk about this fixed asset turnover ratio. Bigger is better, okay? The higher turnover ratio means more sales revenue relative to your investment in fixed assets. So bigger definitely is better because you're getting more production out of your fixed assets. One caveat though, bigger is better as long as the sales are profitable. Notice here that this fixed asset turnover ratio does not do anything to measure gross profit, operating income, net income, or anything that measures profitability. It simply has sales revenue, which, as you know, at this stage of the game, is only one element of the profit equation. Sales minus expenses equal net income. So as long as sales are profitable, bigger is better. If you're selling products at a loss, a higher fixed asset turnover ratio actually will dig your grave more quickly than a lower fixed asset turnover ratio. So just keep that in mind. But of course, if you don't have profitable sales, you may have bigger problems than your fixed asset turnover ratio. Another tool that we can use is horizontal analysis. Now, that's basically just a fancy way of saying that we're going to put financial statements side by side, okay, sequential, within the same company, and then we're going to compare what their changes were. So what you see right here with Blake's Coffee House, we have the balance sheet at the end of 2017, the balance sheet at the end of 2018, and then we've added a column which is simply the percent change. Okay? By what percentage did each one of these asset accounts increase or decrease? And look at the story that this tells right here. Overall, assets increased by a little over 7% for Blake's Coffee House. They rose from $350,000 to $376,000. But our fixed assets, our property, plant, and equipment, net fixed assets only increased by 0.4%. Gross fixed assets increased by a little more than 3%. So what this is telling you is a little bit of information about the composition of fixed assets relative to the other assets in the balance sheet. Horizontal analysis is a tool. We can also use vertical analysis, which we'll see in just a second. With vertical analysis, we take each element of a financial statement and we express it as a percentage of some other element. You see it most commonly with the income statement, where we take every element of revenue and expense and we express it as a percentage of net revenues in most cases. But you can also do it with the balance sheet. What I've chosen to do here, and don't let this confuse you, that I do have comparative balance sheets, but that does not make this a horizontal analysis. I simply am showing a vertical analysis for 2 separate years, because you see, let's take a look at 2018, for example. At the end of 2018, total assets were 376, which means that this is 100% because 376 is 100% of itself. But cash, as an example right here, 22,000 divided by 376,000, that's only 5.9, just about 6% of total assets. And the previous year, cash was a little over 4% of total assets. So this can give us some information about the composition as well. You might remember when we looked at the horizontal analysis for fixed assets, the percentage increase year to year for the fixed assets was lower than the percentage increase for the total assets. So we should expect that the percentage of total assets for our equipment, for our non-current assets, should decline, and that's exactly what we're seeing. Is that previous year, gross fixed assets were about 83% of total assets. That dropped to just under 80. And on a net basis, we went from about 81% to about just under 76%. So what we're seeing here is that the composition of the company's assets is becoming, well, let's say the fixed assets are a decreasing proportion of those total assets. Now, of course, we're just taking a look at a 2-year window here. And this isn't a situation where higher is better, lower is better. It all has to do with your company's asset mix and its overall strategy. But these are tools you can use to help assess the effectiveness of long-term assets within a company.